Welcome to my Money Your Investment channel, the place where smart money meets smart decisions. Today's episode dives into a topic that's rapidly reshaping urban living across Sri Lanka, the future of the condominium industry. From the skyline transformation in Colombo to the rising demand for modern vertical living, condominiums are no longer just a lifestyle choice. They are becoming a powerful investment asset. But what lies ahead? Will the condo market continue to boom, or are we heading toward a saturation point? How will economic trends, foreign investment, and shifting buyer behavior influence this sector? And most importantly, where are the real opportunities for investors like you? In this episode, we break down the trends, risks, and future potential of Sri Lanka's condominium industry, giving you the insights you need to make informed investment decisions. Stay tuned, because the future of real estate might just be rising higher than ever.
You are watching My Money, Your Investment channel.
Imagine a city where 70% of the residents can't afford even a basic, 500 square foot home.
Right, just a tiny starter home.
Yeah, exactly. But simultaneously, developers are practically tripping over each other to build these $100 million luxury high-rises.
It really does sound like a glitch in the Matrix.
It sounds like dystopian fiction, but it is actually perfectly executed economic master plan playing out in real time. So welcome to today's deep dive. I am thrilled you are here because today we are analyzing a real estate market that completely defies standard economic logic.
It really does.
We are exploring the high-stakes evolution of Sri Lanka's condominium and real estate industry from 2025 to 2030.
And the contrast to the data we're looking at today is it's genuinely jarring. I mean, you have unprecedented wealth generation happening on the exact same streets as a severe affordability crisis.
Exactly. And to figure out the mechanics behind this, we're pulling from a really dense stack of newly released sources.
Lots of data to get through.
Oh, tons. We've got a comprehensive 2025 to 2030 industry report that aggregates hard data from the World Bank, the Central Bank of Sri Lanka, the Avocado Institute, Statista, and the Colombo Stock Exchange.
It's a very robust data set.
It is. And our mission today is to explore exactly how an emerging market bounces back from a historic, catastrophic economic collapse to a multi-billion-dollar real estate boom. And more importantly, we're going to uncover the extreme paradoxes hidden right beneath the surface of all these soaring charts.
Yeah, the hidden costs.
Right. Okay, let's unpack this. To understand the boom, we really have to understand the crater this economy was in just a few years prior, right?
We absolutely have to establish that baseline because it dictates every policy decision that followed. In 2022, Sri Lanka experienced the worst post-independence economic crisis in its history.
And we need to be clear about what that means on the ground.
Yeah, this was not a mild recession where corporate earnings just dipped. This was a sovereign debt default.
Which is massive.
The country essentially ran out of the foreign currency needed to import basic necessities.
Yeah.
And inflation skyrocketed to a peak of 69.8%.
Wow, which means the money in your pocket is losing value almost by the hour. Savings are just decimated.
Precisely. Private investment completely evaporated. But, and here's the pivot, fast forward just a bit to the World Bank's 2024 and 2025 data, and the economy has actually expanded by 5%.
Right, which is quite a turnaround.
It is. And the primary engine dragging the GDP out of the mud, a fierce rebound in the industrial sector, driven heavily by construction and real estate.
Yeah, I was looking at the Central Bank of Sri Lanka's data for the fourth quarter of 2025, and the metrics are almost hard to believe.
They're staggering.
The condominium price index in the capital, Colombo, is up 13.3% year on year. And transaction volumes, like the actual number of units changing hands, surged by over 100%.
Which is a massive jump for any market.
Huge. Statista is currently projecting that the total Sri Lankan real estate market will hit $612.6 billion by 2029. So how does a national economy go from an apocalyptic 69.8% inflation rate to a multi-billion-dollar property rush in such a tight window?
Well, the underlying mechanics here are a textbook case of aggressive macroeconomic stabilization. It's all anchored by an IMF extended fund facility of $2.9 billion.
Okay.
Now, that facility isn't just free money, right? It comes with strict mandates to restructure the economy. the government had to implement incredibly painful structural adjustments.
Like what, specifically?
For instance, they forced their tax to GDP ratio up from a dangerously low 8.2% in 2022 to 13.5% in 2024.
So they essentially squeezed the domestic economy, pulling money out of circulation through higher taxes to build a fiscal buffer.
Exactly. It creates fiscal breathing room for the state. Because they pulled that excess liquidity out of the market, they were able to wrestle that near 70% inflation down to roughly 2% by mid-2025.
2%, that is a cliff edge drop.
It really is.
Yeah.
And once inflation is finally pinned down to that 2% mark, the central bank can pull its most powerful lever. They slashed policy rates by a cumulative 800 basis points.
Let's translate that for a second, because 800 basis points is an enormous shift.
Yeah, it's massive.
In plain terms, borrowing money went from being prohibitively expensive to suddenly affordable overnight.
Right.
Like, if you are a property developer, your cost to fund a 50-story high-rise just plummeted, making stalled projects instantly profitable again.
That is exactly the mechanism. Private credit unlocks.
Yeah.
Mortgages become a mathematical possibility again, and developers can access the capital they need to actually pour concrete.
And they are pouring a lot of it. I mean, we can't talk about this recovery without addressing the absolute behemoth in the room, which is Port City, Colombo.
Oh, absolutely.
If you haven't seen the renderings of this project, you need to look it up. It looks like something out of a science fiction film.
It does. It's incredibly futuristic.
It's 269 hectares of reclaimed land. They dredged sand and literally built a new peninsula out into the ocean to create a special economic zone.
Yeah.
The pipeline targets $15 billion in investment. It is expected to create over 83,000 jobs. But the detail that stopped me in my tracks is that they allow transactions in 16 different foreign currencies.
Which is very unique.
Right. At full build-out, Port City is projected to add roughly $13 billion annually to Sri Lanka's GDP.
And for context, Sri Lanka's entire current economy is around 86 billion.
So it's huge. Building Port City is basically like taking a car that was just towed to the repair shop and dropping a futuristic high-performance rocket engine into it. It's literally designed to pull the rest of the economy forward.
That's a great way to put it. It represents a tectonic shift in national output from a single, concentrated geographical zone.
But the way it operates is so distinct. I mean, Port City isn't just an economic engine, it's practically a financial airlock. By allowing 16 foreign currencies and basically bypassing standard local taxes, the government built an offshore financial haven physically attached to the mainland. It protects foreign capital from local currency fluctuations and domestic inflation.
Right, and if we connect this to the bigger picture, you can see how the legislative framework was entirely re-engineered to make that airlock function seamlessly.
What did they change?
Well, in 2026, the government passed critical amendments to the Colombo Port City Economic Commission Act. They completely streamlined the approval process for what they designated as businesses of strategic importance.
Okay.
Yeah, they removed the bureaucratic red tape and introduced highly structured tax incentives. And the strategy yielded immediate results.
I bet.
The data shows that in just a 4-month window between November 2025 and March 2026, Port City attracted $900 million in fresh investment.
$900 million in 4 months.
Exactly. You have tangible projects breaking ground like a $120 million marina developed by Brown's Investments and the $112 million Bay 1 residences.
Wait, this brings up an unavoidable tension. Sri Lanka just went through a severe default. Local businesses were strapped for cash, and the government had to heavily tax its citizens just to stabilize the ship.
Right.
You cannot build a $15 billion sci-fi city on a depleted local treasury. So whose money is actually paying for the concrete in Port City?
It relies overwhelmingly on foreign capital.
But if you are an international investor with millions to deploy, you have a lot of options in emerging Asian markets. You could look at Thailand, you could look at Vietnam. Why park your capital in Colombo?
The competitive advantage is hidden in Sri Lanka's specific legal framework, which is fundamentally different from its regional competitors.
Different how?
Well, in places like Thailand or Vietnam, foreign ownership of property is heavily restricted. They use strict percentage quotas per building or limit foreigners to long-term leaseholds.
Okay, that makes sense.
But Sri Lanka took a completely divergent approach. They allow 100% foreign ownership of condominium units, specifically those located above the 4th floor, with absolutely zero quota limits.
Hold on. 100% foreign ownership.
Yep. No local partner required, and no limits on profit repatriation.
None at all.
That sounds fantastic for the investor, but Isn't that essentially legally sanctioned capital flight? I mean, if an expat buys a condo outright, rents it out, and immediately wires all the profits back to London or Dubai, how does Sri Lanka actually benefit from that long term?
That is the exact debate happening among economists right now. The government's calculation is that the initial influx of hard foreign currency to purchase the unit, combined with the employment generated during construction and property management, outweighs the long-term capital outflow.
I see, so it's an upfront cash grab, essentially. Exactly. Add to that a massive tourism boom in 2025 that surpassed the previous peak from 2018. If you look at coastal areas like Gali, Negombo, or Marissa, beachfront condo developments are generating short-term rental yields of 5 to 8% annually.
Wow, those are great yields.
Right. When you combine the legal frictionless ownership with those robust yields, Sri Lanka becomes a uniquely aggressive and attractive market for international capital.
Okay, here's where it gets really interesting and frankly quite alarming. If foreign money is flooding in and high net worth expats are buying up coastal units and port city penthouses, what is happening to the locals who actually live and work in Colombo? You mentioned earlier that the government taxed the local population heavily to stabilize the economy.
Yes, they did.
Are these same citizens now being priced out of their own capital?
You have zeroed in on the central paradox of this entire data set. While the macroeconomic charts look triumphant, the micro-reality for the average citizen is a severe, almost intractable affordability crisis. The Economist has currently ranked Sri Lanka among Asia's most unaffordable housing markets.
Let's dig into the math on that. According to the central bank's 2025 data, the average apartment in central Colombo costs over 1.1 million Sri Lankan rupees per square meter.
Right.
But the average monthly income is only about 70,000 rupees. That creates a price-to-income ratio, or PIR, of 55.3 times the annual income.
To give that ratio some global context, a healthy, sustainable housing market usually exhibits a price-to-income ratio of around 3 to 5 times a household's annual income.
3 to 5, and they're at 55.3.
A ratio of 55.3 is astronomical. Yeah. The Advocata Institute did a thorough analysis of this, and their findings are sobering. They conclude that 70% of Sri Lankans cannot afford even a basic 500 square foot house in their lifetime.
In their entire lifetime.
Yes. And despite the central bank cutting policy rates, retail mortgage interest rates are highly sticky. They're still hovering around 10 to 12% per year. And banks require substantial down payments that the average worker simply does not have.
If you are trying to wrap your head around a 55 times price-to-income ratio, think about your own salary right now. Imagine you are earning an average middle-class wage and you walk into a dealership to buy a bespoke luxury mega yacht.
Yeah, that's a perfect comparison.
It is not just a financial stretch, it is mathematically impossible. And what's crucial to understand is that this isn't happening because developers are just evil. It's happening because of the market forces operating behind the scenes.
Exactly. This affordability gap isn't just a social justice issue. From an economic standpoint, it is a structural ceiling. It creates systemic market risks that directly threaten the sustainability of this entire real estate renaissance.
But why? I mean, if international investors keep buying the luxury units, doesn't the market just keep humming along, even if locals are locked out?
Only up to a point. Because the act of building these towers is artificially expensive.
Artificially?
Yes. The Advocata Institute highlights severe construction bottlenecks. First, there's a high domestic market concentration in building materials, meaning a few legacy companies control the supply chain.
Okay, monopolies, basically.
Right. But more importantly, there are massive cumulative import tariffs on essential materials. The tariffs on imported cement, for example, range from 27.5 to 38.5%.
Okay, let's look at the developer's spreadsheet here. If the government slaps a 38% tax on your cement and steel, your baseline cost to build a single square foot is already astronomical.
Exactly.
You cannot pass the 38% premium onto a middle-class local buyer. They simply do not have the cash. But an international investor buying a penthouse in dollars, they won't even blink at that markup.
Right, it's a rounding error for them.
So the tariffs literally force developers to build for millionaires because it is the only demographic where the math still works.
Precisely. The import taxes systematically push developers into the luxury tier just to maintain their profit margins. And this leads directly to a severe market bifurcation, which the global real estate firm JLL has flagged as a critical risk.
What kind of risk?
You have the looming oversupply risk in the ultra-luxury segment. Thousands of high-end units are pipelined, but there is a finite number of global millionaires interested in Colombo penthouses.
Sure.
Meanwhile, the actual robust organic demand is in the mid-range segment. Young professionals, newly married couples, returning expatriates. But developers are not building for them because the tariff structure makes mid-range housing unprofitable.
So we have a glut of empty luxury townhouses at the top and a massive wait list for basic apartments in the middle.
Yes, it's incredibly lopsided.
I want to explicitly connect this dynamic to the financial ecosystem. I mean, how do these macroeconomic waves and structural bottlenecks actually play out on the Colombo Stock Exchange?
Well, they play out with aggressive volatility and incredible gains. The Colombo Stock Exchange all-share price index gained 42.46% in 2025.
Wow.
And when you trace the condominium sector's trajectory, you see how it directly inflates a wide web of listed entities. First, obviously, you have the direct developers.
Right.
Companies like Overseas Realty, which handles the Havelock City project, and John Keel's Holdings, which is the largest conglomerate on the exchange. They're building Cinnamon Life, which is a 4.5 million square foot mixed-use complex.
But the ripple effect goes far beyond the people pouring the concrete. When thousands of high-end condos are built, an entire secondary economy activates.
It bleeds deeply into the financial sector. All these rising transaction volumes require major developer financing and retail mortgages.
Oh, of course, the banks.
Right, so commercial lenders like Commercial Bank of Ceylon and Hatton National Bank see direct, substantial earnings impacts from this credit expansion.
And let's not forget the consumer goods sector. The report notes that listed appliance suppliers like Aben's PLC see a huge surge in revenue.
Oh, absolutely.
When a new luxury tower opens, it creates an immediate demand for thousands of high-end refrigerators, washing machines, and smart home systems. Even insurance companies benefit. Properties need to be insured, and the people buying them are frequently taking out life insurance policies against their new mortgages.
It is a highly interconnected and currently very profitable ecosystem. However, a prudent analysis requires us to evaluate the external threats that could puncture this bubble.
Right, nothing goes up forever.
Exactly. The COFACE 2026 Country Risk Report outlines several severe geopolitical and macroeconomic headwinds. For instance, Sri Lanka's merchandise trade deficit widened significantly in early 2025.
I want to push back on that list of headwinds for a second, because a trade deficit is pretty standard for a country importing heavy building materials. What is the actual pin that could burst this bubble? The sources mention U.S. tariffs, Middle East conflicts, and natural disasters. Which of these is the most imminent threat?
The most immediate threat to domestic stability, which underpins the real estate market, is the combination of the U.S. tariffs and Middle East instability.
How do those connect?
Well, in late 2025, the U.S. implemented 30% import tariffs that directly squeezed Sri Lanka's crucial garment export sector. Garments are a primary source of stable foreign exchange and local employment.
Okay, that's a big hit.
Simultaneously, you have escalating conflicts in the Middle East threatening remittance flows.
And remittances are a huge piece of the puzzle. Hundreds of thousands of Sri Lankans work in the Middle East and send their wages home.
Correct. Those remittances accounted for over 8% of the country's entire GDP in 2025.
8%?
Yeah, so if geopolitical instability disrupts that flow of capital, it removes a massive safety net from the local economy.
That makes sense.
And while grappling with those external shocks, the government is still dealing with the fiscal strait of reconstruction after Cyclone Bitwa.
Oh, right.
Their fiscal space is incredibly tight. They're trying to balance IMF mandates, ambition for mega infrastructure, and unexpected climate disaster costs. It requires an exceptionally delicate policy touch to keep this economic engine running.
Okay, let's synthesize what we have unpacked today. On one hand, Sri Lanka is a miraculous case study in macroeconomic resurrection. They tamed nearly 70% inflation down to 2%, unlocked billions in foreign investment through the financial airlock of Port City, Colombo, and supercharged their stock exchange.
Yes, the recovery is undeniable.
But on the other hand, the foundational reality is a severe structural test where the average citizen is entirely locked out of the boom.
That is the crux of the issue. A real estate market that effectively serves only the top 10% of income earners, or worse, solely foreign investors, cannot be a sustainable engine for broad-based national prosperity.
It's just a house of cards.
Exactly. The true measure of success for Sri Lanka moving forward won't be how many penthouses are sold in Port City. It will hinge entirely on whether the government can execute nuanced policy reforms.
Like dropping the tariffs.
Exactly. Can they drastically reduce those 38% tariffs on building materials to lower the baseline cost of construction? Can they implement public-private partnerships that mandate 20 to 30% affordable housing within these mega developments.
Right.
If they can bridge that affordability gap, this real estate renaissance becomes a robust national success story. If they fail to reform, it risks becoming an isolated elite enclave, incredibly vulnerable to the next economic shock.
Think about how these dynamics are playing out in your own city or country. Wherever you're listening from, look at the cranes in your local skyline. How do foreign investment incentives, local zoning laws, and the reality of local wages balance out in your neighborhood? Is there a disconnect between the luxury developments going up and the housing average workers can actually afford?
It's everywhere.
It really is. It is a tension that almost every growing global city is wrestling with right now, though rarely with the dramatic intensity we are seeing in Colombo.
Yeah, it's a universal urban challenge, just hyper-accelerated by Sri Lanka's rapid post-crisis rebound.
Before we wrap up, I want to leave you with one final, provocative concept from the research to ponder on your own. We have spent this entire deep dive looking at the shiny luxury mega towers concentrated in the capital. But the data suggests that the true next frontier for this market might not be in Colombo at all.
It's a fascination point.
Yeah, the sources indicate that if the government finally modernizes its archaic local rental laws, it could unleash a wave of institutional build-to-rent investments in secondary cities like Kandy and Gali.
And that would represent a profound paradigm shift. It would move the center of economic gravity away from the capital, distributing wealth, infrastructure, and development far more evenly across the entire nation.
Exactly. It makes you wonder if they can pull off that modernization, they might not just be recovering from an economic collapse. They might end up completely redrawing the economic map of the country. Thank you for joining us on this deep dive. We'll see you next time.